Hi, everyone. Okay, so here's something that puzzled me when I first started investing. Why do investors value some companies at 5 times their earnings and others at 50 times their earnings? It's not always obvious at first. Is it because one company is a bargain or another is just completely overhyped? Well, the answer to some extent lies in the price to earnings, also known as the PE ratio, which reflects how the market values a company's current earnings and future potential. The price to earnings ratio tells a story about a company's growth potential, its risk, and how the market views its future. But understanding why some stocks have low PE ratios while others seem sky high takes a little unpacking. In today's video, I'll break down what the PE ratio really means, how PE is calculated with an example. I'll look at low PE and high PE case studies. And is PE ratio a good indicator for deciding which stocks to invest in? And if you enjoyed this video, please do hit the subscribe and like button. Okay, so in very simple terms, the price to earnings ratio, so the PE ratio, measures a company's share price relative to its earnings per share, which is known as the EPS. So imagine you're thinking about buying a share of a company, essentially a tiny slice of ownership in that business. Naturally, you'd want to know if you're getting a good deal. That's where the PE ratio comes in. It's a handy number that gives you a sense of how much you are paying for each dollar the company earns. Of course, it's not the only factor to consider, but it is a good starting point for figuring out if the price makes sense. And how is it calculated? Well, it's the price of one share of the company's stock divided by how much the company makes per share, usually over a year. Let's look at an example. Imagine you were thinking about buying a share of a company for $20, and let's say that company makes $1 per share in profit every year. To find the PE ratio, you divide the price of the share, so in this example $20, by the earnings per share $1. So in this case, the PE ratio would be 20. But you might be asking, what does that number even mean? Well, if the PE ratio is high, let's say above 20, it means investors are willing to pay a lot for each dollar of earnings the company makes. Maybe they think the company has a lot of potential for growth, or they're just excited about it for some reason. But if the PE ratio is low, typically let's say below 15, it means investors aren't willing to pay much for each dollar of earnings. Perhaps they are worried about the company's future, or they think it's not doing so well at the moment. So when you were looking at the PE ratio, you were basically trying to figure out if the company's stock is a good deal or it's too expensive compared to how much money the company is making. It's like checking if a car you are buying is priced fairly based on its features and mileage, or if it's overpriced. How about using PE ratio to analyze a stock? Well, what's crucial to remember is that a low PE doesn't automatically mean a good deal, and a high PE doesn't always mean a bad investment. The key is looking at it in context. If a company has a low PE, ask yourself why. Is it struggling, or is it just not in a sexy industry right now? Let's take an example of a company in this situation right now, Delta Airlines. As I record this, they've got a PE ratio of just over 8, which is very low. So the argument here could be, with a low PE ratio of 8.86, Delta Airlines looks undervalued. With strong earnings growth in Q4 and a healthy market cap of 41 billion, Delta, some would say, is a good buy right now with favorable momentum and resilience. The flip side argument, however, is that despite Delta's low PE ratio and strong Q4 earnings growth, the airline industry faces significant challenges: rising fuel costs, potential economic downturns, and ongoing geopolitical tensions could impact travel demand. Plus, Delta's 17.7 billion debt burden and vulnerability to external shocks like the CrowdStrike-caused outage demonstrate inherent risks. Likewise, if a company has a high PE, dig into their growth potential. Are they really growing that fast, or is the market overestimating their future? Need we look further than to Nvidia as the case in point here? Their current valuations drive painful levels of debate amongst investors. Is it overvalued or not seems to be anyone's guess. And I want to be clear here. This isn't about whether Delta or Nvidia are good buys. My point is to show how relying on PE ratio alone can lead to some pretty bad decisions. Personally, I think PE ratio has become a poor metric because many people keep insisting on using it as a shorthand metric to measure cheap or expensive stocks. Yet this is pretty much impossible to derive from PE ratio. PE is just one piece of the puzzle and it needs to be seen in context. You've got to compare it to other companies in the same industry, and what's considered normal varies. A PE of 18 might be typical for one sector, but low for another. And a high PE doesn't always mean a stock is overpriced. Some of today's giants, like Apple, Amazon, and Meta, had sky-high PE ratios when they were growing like crazy, yet they turned out to be incredible investments. At the same time, a low PE can mean a company is undervalued or it might just reflect stalled growth or a lack of confidence in its future. So the key takeaway here is that PE is the starting point, but certainly not the whole picture. It's most useful when paired with broader analysis, so digging into the fundamentals like the balance sheet, cash flow, and income statements, and understanding sector trends and customer sentiment. And that's it for PE ratios. I hope that's been helpful. If you enjoyed this video, please do subscribe to my channel where I explain financial and investing concepts in plain English.